So silver finally decided to show up after years of being sidelined or mocked, really, by traders, ignored by central bankers, and overlooked by the macro crowd. This white metal is back with a vengeance. Silver has broken through the $37 an ounce barrier, reaching levels we haven't seen in over a decade, and it isn't asking for permission. This isn't a gentle rally. It's a full force charge, a long restrained asset kicking in the doors of polite finance and demanding some attention. The obvious question now is, how high can silver go? So let's start with some perspective. At the start of the year, silver was trading just under $29 an ounce. Fast forward 5 months, and it's now touched above $37. That's a leap of 28%. Not bad for something that many assumed would shuffle sideways for the foreseeable future. And the price is just one part of the story. The gold to silver ratio, long considered this barometer of monetary common sense, has dropped from above 100 to around 90 in just a matter of weeks. Now, for context, the long-term historical average is closer to 60. And if you go far enough back to the truly monetary epochs like ancient Egypt, that ratio was nearer to 2. Even reverting to a modern average would put silver well above $50 an ounce, assuming gold remains at its current level. But should gold climb to the $4,000 mark, which was recently predicted by the Bank of America, well, that same ratio adjustment suggests that silver could trade anywhere from $55 to $70. And that's just to re-establish a basic balance in the system, not to price in panic or supply shocks or fiscal chaos. But this isn't merely about technical indicators or ratios. It's a mirror reflecting a world that is rapidly veering off course. The geopolitical terrain is shifting beneath our feet. We are in the thick of deglobalization. Tariffs are still being battled out. Currency disputes are really heating up, and those supply chains are being reshored. That once seamless trade networks, they're fragmenting into rival blocks. Consider Trump's proposed 10% blanket import tariff or that original 145% on China. This isn't tweaking trade policy at the margins, it's trench warfare. And all of this is happening against the backdrop of something darker, actual conflicts. The war in Ukraine grinds on, tensions flare in Gaza, disrupt shipping lanes in the Red Sea, and threaten escalation in the South China Sea. These aren't remote, disconnected events. They are direct stressors on commodity flows, energy routes, and inflationary pipelines. What happens in the Red Sea? Well, it doesn't just stay there. It shows up in your energy bill or your food basket and your portfolio volatility. And while this global chessboard rearranges itself, central banks are walking this monetary tightrope. Inflation is still there. Debt levels are still unprecedented. Interest rates remain high, but feel increasingly impotent in the face of relentless fiscal expansion. And gold has become the favoured safe haven of sovereign reserves and central banks. But silver? Well, silver has been ignored. It's been overlooked, very much unloved. And that, it turns out, might be its biggest advantage. So why silver? Why doesn't it get the same gravitas or attention as gold? Of all the things we pull from the earth, why is silver just left out of that financial conversation, just relegated to the sidelines while gold basks in this monetary glory? Perhaps it's time to reconsider that oversight. So if you just begin with the basics, silver is everywhere. It's in your phone, it's in your solar panels, even your water filters, and even your bandages. It conducts electricity better than anything else. It kills bacteria. It reflects light with stunning precision. And despite all this utility, it has retained monetary roots that stretch back thousands of years. In fact, for large parts of history, silver wasn't just money, it was the money, more accessible than gold, and yet still rare enough to be trusted. It became the medium for daily commerce, while gold was hoarded in temples and treasuries. The gold to silver ratio was not the yawning chasm it is today. It hovered around 15 to 1, not 80 to 1 or 100 to 1. Silver was the workhouse of commerce. It was the people's currency. But what made it money? Well, if we were to design money from scratch, what traits would it need? It would need durability, divisibility, portability, recognizability, scarcity, and stability. Whatever we choose as money, it must be safe to handle. It must be physically stable, reasonably rare, easy to verify, and difficult to counterfeit. It should also be mintable and storable. And if you run those criteria through the periodic table, we pretty quickly eliminate most elements. Gases escape Liquid spills or poisons, reactive metals like lithium are dangerous and degrade. Radioactive materials, let's not even go there. Your paycheck shouldn't come with a half-life. And eventually, you land on the noble metals, rhodium, palladium, platinum, gold, and silver. But rhodium and palladium, they're too rare. Platinum is hard to work with and melts at furnace-busting temperatures. And gold and silver, on the other hand, well, they are both attractive and accessible. But silver, well, silver offered the perfect compromise. It was plentiful enough to circulate, yet rare enough to retain value. Durable, workable, and beautiful. Silver has always belonged to the people. It wasn't always locked away in sovereign vaults or hoarded by emperors. It was in the hands of traders, of farmers, soldiers, and families. It lined our cutlery, it reflected on our mirrors, and even cleaned our wounds. And though it tarnishes, something which is often cited as a flaw, that's merely oxidation. It doesn't lose mass, it doesn't decay. It simply develops a surface layer that can be wiped clean. And that superficial tarnish speaks volumes. It disguises a strength that endures. And it's this underestimated resilience that makes silver such a compelling asset today. So even now, in the age of semiconductors and satellites, silver quietly does its job, while gold lounges in vaults. Silver rolls up its sleeves in solar panels, data centers, AI servers, EVs, and even hospital wards. It's so essential, it's so versatile, and most importantly, it's disappearing. Gold became the standard, not necessarily because it was better, but because it was scarcer. It was untarnished and glamorous. But glamour doesn't power a solar panel. Glamour doesn't sterilize a wound. Glamour doesn't mean utility. In today's fractured and fragile global economy, glamour may be less relevant than ever. Silver has been consumed by industry faster than it can be replaced. It hasn't simply sat idly in vaults because it's been used, and often irreversibly. Above ground inventories are declining. Below ground deposits are harder to access, yet demand continues to rise. Industrial applications, they're soaring, and investor interest is resurging. And this combination is rare and it's really powerful. What we are witnessing now is the convergence of silver's dual identities, monetary instrument and industrial workhorse. Solar demand alone hit 654 million ounces in 2023. Add in AI data, infrastructure, EVs, 5G rollouts, medical tech, and those supply pressures, they just become extraordinary. Silver mining peaked back in 2016. Since then, production has stagnated and recycling is flat. Inventories are being drained to meet real-time demand, and the demand isn't just coming from the West. India, for instance, consumes 19% of the world's silver. This is mostly for jewelry and silverware, but it only produces 18 million ounces domestically. China's appetite is growing rapidly, especially for solar and technology, with silver imports rising 80% year over year in the first quarter of this year alone. And in the East, they're buying with conviction. In the West, we're only just beginning to remember what silver really is. So silver is sensible, yes, but it might not be so predictable. It's physical, it's tangible, it's essential, but it's not sedate. Its reputation for volatility is well earned, and that volatility is not a fault, it's a feature. Volatility means the market is alive, it's paying attention. Flat lines happen to forgotten assets, and roller coasters happen when emotions, expectations, and economics collide. Silver can't decide whether it's a monetary hedge or an industrial necessity. And in truth, it's both. And that is precisely what makes it so fascinating. Its price behavior reflects this duality: reactive, twitchy, sometimes erratic, but always deeply tied to the times. And lately, those times are anything but quiet. So how will it go? Well, we're not in 1980, it's not 2011, but the macro forces shaping this moment, the debt, inflation levels, the currency, confusion, sovereign dysfunction, geopolitical risk, they're all echoing conditions that drove previous silver spikes. So the stage is familiar, but the actors have changed. And this time, the pressures are compounded by industrial strain. Silver isn't trailing anymore. It's not just trying to catch up. How high it goes may depend on how thoroughly the system fails, but make no mistake, $36, $37 an ounce was not the destination. It is just the start. And if you're wondering how you can prepare for a monetary reset, then why don't you download the exit plan? Links in the description below.